On March 12, 2026, financial monitors flashed red across the globe. West Texas Intermediate crude blasted past $94 a barrel, while the global Brent benchmark neared 100. At the same time, gauges tracking inflation expectations spiked to their highest readings in almost 4 years. The markets were pricing in a sudden, massive economic shock. To understand the volatility, look away from the trading floor and toward a specific physical constraint: the Strait of Hormuz. 20% of all oil traded globally must physically pass through this single 21-mile-wide stretch of water. Closing this waterway severs the primary artery of the global energy trade, bringing international commerce to an immediate standstill. On the surface, the market panic becomes a kinetic reality. A direct war has erupted between Iran, Israel, the United States, and the GCC members. The regional waterways are in chaos. Tankers are burning off the coast of Iraq. Drone strikes have hit Oman's largest storage facility, and GPS jamming is blinding cargo ships attempting to navigate the Gulf. Iran's new supreme leader, Mojtaba Khamenei, has officially declared the strait closed, using localized military force to paralyze a multi-trillion-dollar supply chain. Because ships cannot exit the strait, millions of barrels of oil have nowhere to go. Without export routes, massive oil storage facilities across the Gulf are rapidly filling to capacity. The infrastructure has hit its limit. Within days, the region reached 100% of its maximum storage volume. This chart shows the breaking point. Once those tanks hit the red capacity line, Gulf producers were forced to slash their output by 10 million barrels per day. The global market is physically losing this supply, moving beyond a simple shipping delay or a temporary logistics bottleneck. The International Energy Agency has officially classified this production halt as the largest disruption in the history of the oil market. The institutional response was swift. The International Energy Agency, the body tasked with managing energy crises, attempted to stabilize the market. The agency coordinated a release of 400 million barrels of oil from the emergency stockpiles of its member nations. Simultaneously, under direct presidential orders, the United States began tapping into its own strategic petroleum reserve. Despite this record release of emergency oil, prices continued to surge. Peace talks stalled as Iran demanded future strike immunity, leaving the market without a clear resolution. Financial and political interventions remain ineffective against a supply chain that is physically obstructed. The energy deficit in the Middle East has spread into the broader global economy. China halted its fuel exports to protect its domestic supply, while European and Asian markets entered a bidding war to secure the remaining natural gas deliveries. For the average consumer, these market shifts result in immediate, heavy costs. Local gas stations are already posting prices above $7 a gallon. Look at the dual-axis graph projecting the macroeconomic fallout. As growth flatlines and the inflation line spikes, the global economy enters a period of stagflation. This energy shortage is now spreading through global finance, threatening the stability of markets and the daily livelihoods of billions. The modern global economy relies on a highly fragile physical delivery system. The events of March 2026 demonstrate that strategic reserves and political declarations cannot save a system when its physical arteries are blocked. Until the ships can safely sail again, the entire global economy remains held hostage by just 21 miles of water.